Well, we've just capped an uncertain week that saw many investors, both local and international, shying away from the market somewhat. A U.S. jobs report on Friday helped boost volume somewhat, but what we'd really like to know is what happened last week and how is that going to impact markets next week? To answer those questions, we have here live in the studio tonight Chartist Cheng, who's also head of retail research and equity markets at Maybank Investment Bank. Welcome, Cheng.
Hi.
Good to have you on the show with us again.
Thank you.
Oh, we really like you here. Okay, now what has been happening with the world markets of late, specifically in USA and China?
Okay, let's start with China. Actually, what happened with China was the central bank was very concerned about inflationary pressures, so they've drained liquidity out as well as tried to slow bank lending down. On National Day, when we were off on holiday, the China market fell around 5 to 7%, and this had a spillover effect onto other world markets, Europe as well as USA. And of course, you know, we had a tumultuous week. Only at the end of the week, I think the Chinese authorities softened their stance a bit about this, tightening of the curbs. So what happened is the markets rebounded back, assisted by a better purchasing managers index in China. That was, I think, the best in 16 months. And of course, US, the so-called job losses weren't as bad as 216K on the last month. Expected was 225K. But the so-called ugly side was a 9.7 rate of unemployment. That's for August. The previous month was 9.4. So the rise was indeed ugly, but on a day-on-day basis from Thursday to Friday last week, the Dow was up, but on a week-on-week it was down like about just over 1%. So that was actually what happened with the world markets, and this adversely affect world markets as well as Europe as well as the Asia Pacific zone, including the KLCI.
Well, the U.S. jobs report, I mean, despite being better than expected, it still is the worst in U.S. history.
Yes.
And yet, volumes did pick up upon seeing that report?
I wouldn't say it's worse than, it's worse since 1982. It's about a 34, closer to 35, 36 years sort of low. It could get worse. People are expecting into next year 10% and even more than 10%. It could get that sort of ugly, in the months to come.
Is it perhaps indicative that, I mean, the labor market is a key component to economic recovery. Is it perhaps indicative that the U.S. market hasn't improved as much as everyone has liked?
Well, 5 banks went belly up again, bringing the total to 200 in the year 2009 to 89 banks in total now. I think this is the worst since the crisis happened. So job losses are actually indeed adding on. And what's very important is for consumers in the States, they represent about 70% of the GDP. So if the consumers don't consume, how are the Asian markets going to export their way out of this depression? And definitely their savings rate has gone up, their trade balance has shrunk, and they're definitely not consuming. When they're not consuming, there's just no spending there. So we have to look into companies like Walmart to see whether is there a true pickup among U.S. consumers? The Cash for Clunkers program, that's their car program, has stopped. So these so-called U.S. measures to help stimulate the economy is slowing up. So without these extra programs, we shall see in the months to come whether they are able to survive on their own, whether companies can actually add on their profits or show better performances. This remains to be seen.
Okay, let's just go for a short commercial break. We're still taking questions for Cheng Hooi here in the studio. We'll be back right after this.